David, I want to ask you sort of a philosophical question, perhaps, and that is, what does the world look like if let's even say that PIMCO's prediction of 0% or sub-zero negative yields in the U.S. is not absurd, and that we go with Bank of America, which says sub 1% on 10 years possible, or we go with J.P. Morgan that says what's going around the world is basically quicksand for the entire fixed income complex in the United States. So what does that mean for us here?
It sounds like scarier, and even scarier. Look, I think there are a couple of different things going on. One is the world economy clearly has slowed. We saw some bad numbers out of Germany. The world economy is behaving a little differently than people expected. Inflation refuses to go sustainably to 2%. And the Trump administration is creating a lot of trade friction and uncertainty that's clouding the outlook. So it's not surprising that global interest rates are falling and there's pressure on the Fed to ease. If we get to the situation you described where, long-term rates hit zero and stuff, I would say that's an endorsement of the Larry Summers secular stagnation hypothesis, and there'll be calls for some really strong fiscal stimulus to try and bail out the world economy. But I don't think we're quite there yet.
The folks on the fixed income side, Mike, are sounding, I don't want to say the alarm, but they're forecasting very, very low rates.
Yes.
The folks on the equity side of the picture, though, are still bullish on stocks.
That's right.
What gives?
It's not entirely in conflict, Melissa. I don't think. I mean, obviously, there's a tension in that outlook. We're in the extrapolation phase of figuring out what bonds are doing, right? You've accelerated lower in yield, and everyone says, I don't know what breaks this cycle. We said it in 2016, too. Look at the charts. The bond market doesn't always smoothly price in exactly what's going to happen. You see these jagged moves up in yields. And right now, at least on a short-term basis, tactically, bonds are overbought, they're overloved, they're overbelieved because people are absorbing all this stuff. That being said, the Fed, if they don't ease and bond yields globally remain where they are, they're effectively saying we're ignoring a lot of these market signals because short-term U.S. yields are very much an outlier against almost everything else.
How much is this a function of just analysts who are sort of locked in place with these predictions and they can't get out of them?
On the
equity side, meaning, they come on here, they're so locked in that actually to pull back right now is almost just it's admitting defeat.
Well, perhaps, but you're down 5% from an all-time high. You've kind of been flat for 18 months in the U.S. stock market. And one of the inputs in how you value stocks is what's the risk-free rate. So, I mean, I think the math gets you to a place that says, I'm not yet going to abandon things. By the way, equity investors have gotten really bullish. Leslie talking about how hedge funds are sitting this out or are bearish. Individual investors have gotten scared. It looks like a little bit of a shakeout for now if nothing systemic happens. If there's not some kind of real break in the system, the credit markets, they've softened up, but they're not really sounding loud alarm. So I do think it's a very, very ambiguous period.
David, I've got a question about looking down the road. Yesterday, there were, I guess the back of my knees got sweaty the way they did in the financial crisis.
Oh, my. Let's not talk about that.
That's a lot of information.
Take a shower, Steve.
I got nervous yesterday. And I started thinking about how central banks coordinated during the financial crisis. And my question to you is this. Are central banks coordinating now? Do they need to coordinate? But most importantly, could they coordinate? In that the finance ministries are all screaming at each other, and there's no sort of polity among the governments.
Truce?
Well, I guess the question also to David is: are we do we have a currency war, a trade war, and a central bank war going on all at the same time here?
No, I don't think so. But I think what's going on is, and what you're picking up, the back of your knees are picking up, is the risk of the really bad outcome seems to have gone up. And what we're all remembering is all these warning signs in August 2007 that preceded the calamity that followed. And we're asking, are these the tremors that suggest the big financial earthquake is coming? And the short answer is we don't know. I don't think the central banks really need to coordinate now. Look, basically, the European and Japanese central banks are desperate to kind of get their economies moving. The dollar is strong because the U.S. economy is a little stronger. But there is a certain amount of, I would say, communication needed. But I don't think they're going to coordinate. I don't think they coordinate that often anyways, except in extremis. And then, of course, you add to this is like, is what's going to happen in Hong Kong and what's going to happen in the Middle East and what's going to happen with Brexit. There's so many things that could go really bad for the world economy. It's not surprising that people are getting a little nervous.
The first part of your answer, the second part of your answer, David, suggested they should be coordinating. And I just wonder, the Fed cut on Wednesday, and you had 3 central banks cut more. And is there some sort of spiral here where if the Fed cut again, would the other central banks cut even more?
But some of the central banks that cut don't really matter that much. I mean,
Fair
the
enough.
Thai central bank.
Fair enough.
What matters here is what is the ECB, what does the Bank of Japan, and what does the Bank of England do? And the Bank of England seems to be holding firm. The others have signaled for their own purposes, given their domestic economies, they're going to ease.
Brian.
Look, if the world economy is really bad, having all the central banks ease, whether coordinated or not, seems like the right policy. The question is the economy that bad, and can the central banks rescue it if it's the politicians creating all the problems?
Brian, what does this fixed income environment mean for the global banks, not the central banks, the actual stocks of the big global banks? We've had the yield curve go inverted. We've got sinking rates. We had a guest come on yesterday. His big buy ideas were the big global banks. Other than saying, Jamie Dimon's a great manager, why would the viewers buy the securities of those companies?
I mean, those, of course, have struggled as the rates have come down. And quite frankly, over the long term here, even over the intermediate term, while we might get a little bit of a bounce, I do see rates continuing to move lower. And the yield curve inversion also I think is a big problem, basically for what it foreshadows into the future. So, yeah, I think there's some concerns there, and there should be.
All right, we've got to leave it there. Thank you all for joining us, Brian, David, and Mike.